Hello, everyone. Welcome to the show. Today's show is called The Pitch, 15 Stock Ideas in Uncertain Times. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. And in living through the last 4 to 6 weeks, seeing this bear market move 30+%, seeing the quick snapback rally in the last week and a half, we had the idea of bringing on some of our top contributors to give us a little bit of insight in terms of how they're approaching this environment from a stock picking perspective, give us a window to some of the names that are looking compelling to them at this point. So we've asked them each to contribute 5 stock ideas that we'll each present. Then we'll be able to discuss them as a group. So I want to welcome on our 3 guests. First, we have Tom Bowley. Tom's a Chief Market Strategist at Earnings Beats and the host of Trading Places with Tom Bowley. Tom, welcome on.
Hey, Dave. It's great to be here.
Good to have you. Number 2, we have Ellen McGonagle from MEM Investment Research and host of a number of shows on StockCharts TV. Mary Ellen, welcome.
Thanks, Steve.
And number 3, we have our own Grayson Roze, who's the Vice President of Operations at StockCharts.com and also hosts the Traders Journal blog on StockCharts. Grayson, welcome.
Hey, Dave. Good to be here.
Good to have you all on. I want to get right to our stock picks, try to make sense of all of this. So as I described in the introduction, willing to give everyone a bit of a window into each of your processes and how you, what sort of ideas look compelling. So I'm going to pass it first to Tom. I'm going to ask you, just to very quickly summarize, how did you approach this question of stock ideas in this environment? And what are your 5 names? Walk us through the chart. So first, Tom Bowley.
All right. Thanks, Dave. Yeah, what I do when I see a major change in the market, and I think this certainly qualifies as a major change, what we've seen since February 19th top, is I try to look to see what Wall Street is telling me are areas that we should be focused on, either on the bullish side or on the bearish side. So I look at the S&P 500 back on February 19th, and I look at the S&P 500 on March 23rd. And I look at this huge decline, and then I go back and I look at all the industry groups and the various sectors to see where they were back on February 19th, where they were on March 23rd, to get a little bit of a snapshot from Wall Street as to how all the big firms are looking at what's taken place in the market. I mean, I'd like to think that I'm smarter than everyone else out there, but I know I'm not. So I'd rather have that expertise showing up for me on the charts. And I do it really via relative strength more than anything else. Now, I am also using accumulation distribution on my charts nowadays as opposed to RSI, just because I think accumulation distribution really gives us a good sense as to what's been taking place throughout the trading day, because we have seen a number of gap downs. So I like to see what's taking place during the day. So it's really a combination of all that, relative strength, and then looking at the action throughout the trading day to see if stocks or industry groups and so forth are actually selling off during the day, or if they're actually being accumulated. And when you look at all the various industry groups, there's quite a bit of diversity there. So as I go through my list of stocks, I actually had a few themes that I thought emerged pretty well. And one of them, there's a company called Performix, a really big online marketing company, and they looked for a 2-week period earlier in March at search stats in Australia to get a sense of what people are thinking, because in their minds, intent leads to action. And so when you went through and I looked at some of those, one thing that really stood out was obviously working from home, and another one was exercising, because people like to get out and exercise, and a lot of the gyms and so forth have closed. So now we need to take a look at some of the areas that I think can benefit in those 2 areas and maybe a couple others. So starting out with that whole theme of working out at home, I think Peloton is a very interesting candidate. Now I've got the chart here, and you can see down at the bottom, the accumulation distribution. It actually just broke to a new high, even though the stock price is going down. This is an indicator that was, first calculated by Mark Chaikin. He's the one that came up with the accumulation distribution indicator. And I think in this kind of a market, it really makes a lot of sense. So when I look at this chart, I see a stock that's been going down, but a stock that's being accumulated, in my opinion. Now, a couple of stats to think about on this stock as well. Number one, they have 1.4 million members, at least at last check. A second thing, and this is really big, they have 42 million shares in their float. 23.4 million shares were short on March 13th. That was down from 38.7 million shares short. I mean, these numbers seem absolutely astounding to me. But the short percentage of the float, as of just a couple of weeks ago, was 56% on this stock. So you've got guaranteed buyers that I think also are out there in the form of a potential short squeeze. So I think Peloton is one that definitely I would keep an eye on. A second stock that I wanted to point out, and this is just the whole pandemic idea to, as a whole. We tend to not only deal with the pandemic now, but once the pandemic is over, everyone's going to be focused on making sure we don't have this problem again. And one of the stocks, one of the biopharmas that currently has a relationship with the Department of Health and Human Services. Here's an article here that we can go and take a look at MedCity News. But this is a company that is developing a vaccine or trying to develop a vaccine. There's a number of companies out there like it. But when you look at the chart on Regeneron, you see a company that's been trending higher. The accumulation distribution in March set a new high, which I like. And then when you look at a relative strength, this was a company even back in January that was moving to about an 8 or 9 month relative high to its biotech peers. So it was already a company that was beginning to gain some, at least gain some strength on a relative basis. And I think this is just adding to it. So I think that Regeneron, after moving to new highs with a negative divergence, which doesn't show here, but the PPO was lower, I think it needed time to consolidate, which it did, and it's starting to rise again. I think this is one that looks pretty good. Let's go to a third one. The third one is Zoom. Zoom video communications. That's what we're using right here. This is what we use at earningsbeats.com to help keep our members up to date in terms of what's going on in the market. This is how we share our knowledge. So we've got online learning capabilities. So if you take a look at the Zoom chart, you can see all the volume coming in here on Zoom. This one also pretty high in terms of the number of shares short, 116 million share float, and about 8% of that was short as of March 13th. So you're getting a short squeeze, and you're also getting this new dynamic. Zoom is great for those that want to work from home, online learning, those types of themes. So I think Zoom is a great stock to consider. A fourth stock would be PetMed Express. This is a company that does business as 1-800-PET-MEDS. They operate as a pet pharmacy, and so they offer pet prescription, non-prescription meds, pet health products, pet supplies, etc. But they market all this directly to consumers via its website. So with social distancing, you don't have to go in the stores. It's an online platform. You can see the stock almost ready to make a breakout here. I think Pets looks pretty good. And then the final one that I have is Wingstop. So let's pull up Wingstop. One of the most interesting parts of this is that restaurants have actually bounced back pretty nicely of late, and restaurants rank 44th out of the 104 industry groups over that time period I mentioned earlier, February 19th to March 23rd. And so Wingstop, if you go back, this is a 5-year chart. Look at the relative strength in this stock versus the restaurant and bar peers. This has been one of the best ones. They just broke out again on a relative basis. And so this is a stock that I think looks pretty good. And as a final point here that I wanted to make, if we look at the accumulation distribution, breaking out to a new high, and that's been a theme among a lot of these stocks that I looked at. So those were the 5 I think that are worth looking at as we move forward.
That's a great breakdown, Tom. And as with any of these discussions, that chart of Wingstop is one I didn't realize how resilient it had been out of the lows, almost gapping up and finding new strength there. Thanks for breaking down the process and some 5 great ideas. Let's go right on to our next speaker, Mary Ellen McGonagle. Very quickly, what is your process? How'd you approach this? And then walk us through your 5 names.
You bet. Yeah. So from my work, I'm always on the prowl for, similar to Tom, relative outperformance. I want to see where that strength is, where the interest is in the markets, the money flows, and so forth. And I also need to see growth by way of either revenue or earnings, not only existing growth, but growth prospects looking quite positive. And there are definitely names that are popping out of the mix and have been relative outperformers and have significantly improved growth prospects since this work at home quarantined, this whole shift that we've seen within not only the workforce, but just among people in general in response to the coronavirus. So there is commonality among the stocks that I'm going to be sharing with you. And one is taking a look at stocks that either held their 200-day simple moving average. Each of the names I'm sharing did either find support or just dipped below. And the significance there is that during the steep decline that we've seen into bear market territory, only 4% of all stocks listed did hold support at their 200 days. So certainly that is a significant point as far as showing strength and not deteriorating as much as the broader markets. Let's take a look at this first name. It's Microsoft. And we can see that Microsoft did fall in line with the markets, but it just dipped below this 200-day simple moving average. And the company has a lot to talk about. They reported earnings back here in the beginning of February, 39% year-over-year revenue growth. This is prior to coronavirus hitting. And the reasoning there is because they have commercial cloud revenue from Azure. That's one of their products. Office 365, which is a productivity software that's now cloud-based. They also have gaming that is seeing a huge pickup now, and they've just partnered with Slack, which has seen ridiculously huge new client acquisitions. So Skype is another part of Microsoft. They surged 70% this month as far as new people using Skype. So we have a lot of growth prospects going forward. We can see the stock undercut. We are poised for what we call a golden cross, where this shorter term, in this case 10-day simple moving average, is poised to cross up above this 200-day simple moving average. That would be in addition to the stock on this daily chart having a positive RSI. And then we have this MACD black line up through the red, bullish crossover. So very interesting looking currently. And I'm going to just take a very quick look here, share with you the weekly price chart with Microsoft. And we can see on the weekly chart, your longer term charts are going to be more forward looking as far as your deductions that you can make. And we can see that the RSI is positive. This is highly unusual on a weekly chart. MACD never got negative. It's still up here above this net neutral zero in positive territory. A break above this red 10-week or 50-day simple moving average would be even more bullish for this stock. Let's go ahead and take a look at another stock that just undercut its blue. This is the 200-day simple moving average. This is a semiconductor stock, NVIDIA. And they announced their earnings back here in late February. We can see the big gap up prior to the drop within the broader markets. The company announced earnings super strong, but they also kept their outlook intact despite coronavirus and its potential impact. Huge news. Their big story is they are providing their chips to data centers. Huge growth, even going in. That growth has even gotten larger. Two Wall Street firms raised their estimates for the stock this week, and they are also providing graphics chips to help with coronavirus and testing. They have a big component or a piece there as well. We can see the stock broke back above this 50-day simple moving average on this daily chart. Very bullish. This is an uncommon occurrence. You're not going to see a lot of this. The RSI is positive, and then we did have that positive black line up through the red, that MACD crossover. So I would take this stock, certainly keep it on your watch list if you're not investing, or potentially take a nibble here because of this bullish action. Let's take a look at a stock that's in the retail space. This is Chewy, CHWY, and the company provides, it's all about pets food, pet products, and they've seen a significant jump. This is a highly unusual stock hitting a new high here. RSI is positive, MACD is, as well. They're finding that the US consumers have a very high savings rate compared to prior recessions, and they are spending it on their pets. Big part of their move is with dry dog and cat food. People that are hoarding toilet paper, they're also hoarding food for their dogs. The one thing of note is the company is due to report their earnings on Thursday. We've seen other retailers come out with positive numbers, but they have pulled back. This stock is definitely priced for perfection. I would not be a buyer going into earnings. Let's take a look at another stock here that is certainly computer software related. This is Cloudflare, N-E-T, and the company provides a cloud-based security solution. And this is a look here. It's an IPO and newer issue, quite a lot of in the way of volatility. But they did come out with numbers in February. Earnings not in place, but they did show 51% year-over-year revenue growth. Very bullish. We can see the stock is trading above this 10-day simple moving average, RSI and MACD, both in positive territory. One last stock we can take a look at here is another communications software stock. It's Ring Central. This has been a favorite of mine for a long time. We picked this one up back in '06, still coming out with big numbers. They reported here at the end of February's earnings were ahead of estimates, and we can see the stock did just undercut this 200-day simple moving average, but we're experiencing a nice V-shaped recovery. Stock is up above that red 50-day simple moving average. The RSI and the MACD are both positive, and going to leave it at that.
Mary Ellen, those are five great charts. And what strikes me about three of those, with Ring Central, with Cloudflare, NET, and with Chewy, I always mentioned I'm interested in stocks where if you didn't know the world had ended, and the market had sort of capitulated, some of those stocks like Chewy, it actually, you wouldn't know it looking at the chart. The chart appears to just be in sort of a slow and steady, move higher, right?
Absolutely. And the company, if you go back here to this late February period, they were poised to break out of this nice base on a daily basis. They already had nice growth metrics in place going in, and now they have increased sales, again, because of that hoarding and that desire to keep your pet happy while you're at home with them.
I love it. Great charts, Mary Ellen, and thank you so much. I've got some questions, but I'd like to bring on our third panelist, and then we'll open questions to the group. So Grayson Roze, if you could take the screen. Thanks for joining us. I'd love to just get a breakdown of how you approach this question. How do you pick five stocks in this sort of environment, and then walk us through the charts?
Absolutely. Well, Dave, it's a tough environment to be in because it's so different than where we've been for the last 11 years. This is a moment when, in these sorts of bear market conditions, there is real fear out there. There's real fear among all of us, not just investors, but among all of us. And there's real hardship that people are dealing with. But for us as investors, even those of us as investors who may be dealing with that same hardship, these moments are incredibly powerful, I always find, because it's still an opportunity to think critically, to think strategically, and really as an investor to be creative. When I think of a bull market environment like we've had for the last 11 years, I think of a period where we're following trends, we're finding strength, we're taking advantage of that strength, but it's relatively routine, right? It's kind of process oriented, and we're going through sort of the same things day after day and week after week. But in a bear market, so many of those trends are thrown up in the air. So much of that strength changes. And so what we have to do in a bear market environment is really kind of think bigger, evaluate the world that's changing around us, and think about those changing forces kind of in the context of markets. Ultimately what we're facing right now is a tremendous amount of chaos, right? But chaos creates change, and change represents opportunity. So when I think about myself as a trader, as an investor, as someone who's going to participate in the markets for a longer period of time, I'm trying to position myself right now to take advantage of the opportunity that's going to come out of this. So, think back to 2001. 2001 was an incredible opportunity to think about the technology that was really going to stay around, think about how the internet was going to change the world, those kinds of concepts. 2009 was an incredible opportunity to think about social media, the impact that was going to have on the world. digital payments, Web 2.0, all of these big themes that we've been looking at for the last 11 years, those were starting to play out coming out of 2009. So what I'm trying to spend a lot of time doing here, in addition to watching markets and seeing, trends that are breaking, trends that are developing, all those kinds of things, I'm expecting to see tremendous outperformance coming out of this as I'm thinking through the chaos to the other side. I'm expecting to see tremendous outperformance coming out of what I'm calling the disconnected economy. The companies that stand to benefit from an economy that doesn't need any sort of interaction, any sort of physical interaction, the touchless economy, that's where I'm sort of looking. So what I wanted to do here was show you how I'm actually doing that. I'm here on my members dashboard. I am going to hit my chart list button. Now, these are all of the chart lists that I have in my account. So you can see here in this section, I have a whole bunch of chart lists called theme trades. So what I'm trying to do is think about some of these themes that are going to emerge from this moment. Some of them are already staying strong, and actually Tom and Mary Ellen have touched on a bunch of them. But I'm trying to think about some of these themes that are going to find strength coming out of this. And I'm tracking those and just kind of thinking about them, building up my watch lists so that as we start to come through this, I can start to look there and see what sort of strength is emerging. So in particular, the three themes that I think are most powerful coming out of this, I think we're going to see a fundamental change in the way that we work. We are seeing already this incredible shift to remote workforces. That has been a theme that's kind of been playing out slowly for the last couple of years, but this is sort of the catalyst that drives it and makes it much, much bigger and gets a lot of businesses across the world to embrace that. Similarly, I think we're going to see an increased rate of adoption in the cloud as a result of this. StockCharts actually went through a major cloud migration last year, and if we were still in our old data center, we would be panicked like you wouldn't believe right now. But because we've gone through this cloud migration and we're up in the cloud, we're much more flexible and much better positioned to take advantage of this moment, to sort of thrive throughout this moment. In addition to that, I think that we're going to see accelerated growth in online shopping. We're already seeing this. So many people are, forced indoors. They can't leave their houses, and so they're shopping online. They're getting their groceries delivered. All those kinds of sort of online digital retail themes are already starting to play out. And I think that this is a moment and an experience that gets a lot of people to say, I'm not going to buy my toilet paper, at the store anymore. I'm going to buy it online. So for this presentation, I've got 5 names here, Atlassian, Five9, Microsoft, Amazon, and Shopify, that I think are really well positioned to take advantage of these themes coming out of this moment. So we're going to jump in here with Atlassian. Atlassian is a collaboration software company. So they provide a lot of tools that help remote workforces come together, all work from different places, manage projects, communicate, those sorts of tools. So here with Atlassian, what I'm mostly looking at is tremendous outperformance right now. Even for a stock that's pulled back, we've seen this outperforming the market, staying strong. Technology has been staying strong. So here's the technology sector relative to the overall market. And Atlassian, in all 4 of these relative strength charts that I have, is just continuing to outperform. We did see a bit of a dip below the 200-day moving average, but kind of just within this broader consolidation pattern and not really breaking below some key levels from the past. So now we're seeing that trading back above it has traded above the 50. Today was a little bit of a drop. But I'm expecting to see continued strength from Atlassian here as one of these collaboration sort of remote work plays. Similarly, Five9 is a small cap company that is cloud software for contact centers. So you've got all these contact centers around the world, right, that are, support teams and those kinds of things that are suddenly having to disperse and shift and work from home. Five9 is positioned to take advantage of that. And I mean, this is a stock that made a new 52-week high intraday today. That's just beautiful movement. Really not much of a break below the 200. All these moving averages are rising here. And again, we see outperformance. We see strong relative strength from Five9 here, which I love to see. So as a remote work play, I think this is another perfect one. Interestingly, now Mary Ellen covered Microsoft, so I'm not going to spend a ton of time on it, but similar concept. Again, we have outperformance here from Microsoft. And what's interesting to me about Microsoft, Again, not much time spent below its 200-day, now back up to sort of nice levels, outperforming the market. What's interesting about Microsoft is that they're well positioned to do two things. One, remote work. Two, cloud. Those are major, major drivers for Microsoft's business, and they're positioned to take advantage of two of these themes. Similar to that, Amazon. Amazon is beautifully positioned to take advantage of the cloud theme that I'm talking about, but it's also positioned really well to take advantage of this online shopping, increased online spending theme. So again, Amazon has sort of been in this longer term consolidation pattern, back up nicely above its 200-day though. And again, outperforming here. And what's interesting is just, step back away from the charts, think about your own shopping, your family shopping. So many people right now just spending all of their time, buying their groceries and everything on Amazon. So tons of experience there for Amazon, tons of new clients there for Amazon. I think this is a stock that's well positioned to outperform coming out of this. And again, if we think about that online shopping theme, the one that I have to go to is Shopify. Shopify provides basically the guts of all of these online shopping companies. When you think about, buying sweatpants or shoes or something online, some sort of online retailer, Shopify is the business that actually, or the product that actually sort of supports that, the underlying technology. Again, beautiful long-term trend here on Shopify. We broke barely below the 200 days, not much time spent below it. Lots of moving averages just trending up beautifully here. And most importantly, strong relative strength, outperforming the market, outperforming, its industry group. That's what I'm looking for here. I'm looking for companies that are staying strong through this chaos and are well positioned to come out of it on the other side, staying strong. So those are 5 of the names that I'm really looking at. And they're sort of all slotted into these 3 larger themes that I'm really kind of looking at and expecting to see more from as we come through this chaotic period.
Those are great charts, Grayson. And this has been so much fun already. I have the pleasure of being able to ask questions of all you guys, just thinking and hearing what you have to say. What strikes me off, besides the fact that a couple of things. Number one, all 3 of your charts, you all had a chart style that was very unique and very different. And I'd love to just pick very quickly through each of those and just talk about them. And so it's really interesting to hear how you all approach this, but then visually how you're analyzing the charts. And as you talked through them and showed us what you were doing, that was really, really compelling. So, I'll start with you, Grayson, just because you finished on number 1. You have the prettiest charts of the 3, so I give you that crown right off the top.
Well, Tom's jealous because he used to use Sunset. So
yeah, I'm not even gonna comment right now. In fact, I gotta go, Dave.
Beautiful charts, but it strikes me when you showed the list that all the 5 stocks that you picked all had were in the top 5-6% of the scooter rankings. They all were like 94, 95 plus, if you think of that ranking system. And I didn't look at them for all of your names, but I would assume that for all of you, they're sort of in that bucket. Was that an intentional effort to look for stocks that rated high based on that ranking, or did that just naturally come out of your process of picking some of those names?
It's a little bit of both. I was struck by how it sort of naturally came out. But actually, if I scroll down, I've got my big charts here so that they fill the screen. But if I actually scroll down on my chart style, like you were talking about, I have the scooter charted at the bottom of my chart. So it's an important piece of what I look at. I'm always looking for things that are staying above that 75 level on the scooter. But yeah, it's funny how they just sort of naturally came out there. But it's a great sort of confirming signal for me. I'm always looking. Relative strength really is number 1. That's why I have those 4 panels at the top of my chart style. And scooters are sort of the 5th panel, if you will. I have the 4 relative strength lines at the top, but scooters down below. So it's amazing to see the continued strength from those names, and the scooters just capture it perfectly.
Now, Mary Ellen, it strikes me that you identified names that were doing well on a relative basis, even though you didn't show the relative strength on your chart, but you naturally gravitated to some of the stocks that were holding up really nicely. And things like, Cloudflare maybe come to mind. This is a stock that's doing very well on a relative basis, even though that wasn't necessarily something you showed. How do you think about how a stock like this relates to all the other names? How does that fit into your process?
Yeah, so I think I mentioned the names that I'm going to be more gravitated toward are going to be those that had growth prospects going into the coronavirus. And now we have a double added bonus where they are seeing added growth because of the coronavirus and its new impact and new dynamics, individuals working from home, of course. So in addition to already having good growth prospects, they again have increased growth prospects. So that's what's going to be attractive to me. And you can also pull up, well, it's a little tougher for an IPO, a shorter name, but some of these longer ones, when you can even look at Microsoft on a daily, when it had that price break, I also add a 21-day simple moving average. So on that Tuesday, I was able to alert clients to the fact that these stocks had turned very near-term positive. So when you look for breaks above simple moving averages and can combine that with other technical attributes, it's pretty powerful.
Very interesting. And then, you know, Tom, when you sort of started off, I noticed you had accumulation distribution, which I think is a technique that probably some are not as familiar with. Can you just briefly describe how you use that and how you apply that to really imply relative strength, right? I mean, it's telling you when stocks are in a good position, but what is that telling you in particular?
Well, I think first of all, the accumulation distribution just gives you a little different angle. When I look at a chart technically, I try not to get everything that lines up the same. I mean, sometimes if you look at stochastics and you look at RSI, those two tend to go hand in hand, maybe even a little bit with the PPO. I think the accumulation distribution just gives us a little bit different angle. And so what I had noticed, I had gone back and calculated the spider and the QQQ from, I think it was the February 19th high through sometime around March 22nd, I believe, or 23rd. It may have been all the way through to the low. And what I found is, shockingly, and unlike any other period I'd ever seen, 100% of the drop in the QQQ from February 19th to March 23rd came at the open. It was the entire drop. If you go back and you look at the net opens throughout that entire period, the entire decline came at the opening bell. And the rest of the trading day on a net basis over those 5 weeks was flat. And so there was a lot of stuff going on during the day. I mean, obviously some stocks were continuing to go down throughout the day. Some stocks were going up throughout the day. But one of the indicators that I think, and again, this was developed by Mark Chaikin, so I'm not taking credit here. Mark did a brilliant job coming up with this indicator. But what it tells me, and it's a lot of times used kind of with on balance volume, but on balance volume simply looks at, did you go down from yesterday? If you went down from yesterday, it's a negative day. Accumulation distribution takes a little different look at it because how you trade during the day has a much bigger impact. And so knowing how the market had traded and knowing how the market had gapped down, I really wanted to try to find out which stocks were actually, in my opinion, or based on the charts, which stocks were appeared to be accumulated through all of this down move. Because if you've studied the accumulation distribution, what Mark explains is, and what he looks for, are stocks that are going down in price. And I'm just showing you Peloton as an example here, but stocks that are going down in price, but up on accumulation distribution. So if you just simply looked at your account and you were holding the stock, you think it's a horrible stock. But the accumulation distribution is telling us that, hey, you know what? During the trading day, this really isn't a bad stock. And I was looking at some of the stocks that both Mary Ellen and Grayson offered up as well as they were going through them. And I was pulling them up, looking at the accumulation distribution. And most of those stocks were very, very strong in this accumulation distribution as well. So I just think the accumulation distribution provides another angle to help confirm what you're seeing on the charts, or maybe even uncovering some things that you're not seeing on the charts.
That's a great point. You know, as I was looking at the tickers that you all, you know, were selecting, and as you're going through your process and names, what struck me, we're looking at a chart of the XLK now together. What struck me is that one of the consistent sectors that you all picked at least one technology name in there, some more than others, but you know, a couple of you had Microsoft, and you know, there's been this theme of the resilience of technology, and that is not a new theme. That, I mean, if you look at the relative strength in technology, it's been just this consistent sort of, you know, steady up and to the right relative outperformer. My question to all of you, you know, since you all selected at this point, at least one tech idea made sense, and you probably, if I gave you 10 options, you might have another couple in there. what would you see, or what would tell you to start to lean away from technology? Because I feel like the, classic answer now has been put some tech names in there because it's just worked. What would you need to see? Is there something on specific names or specific groups like semiconductors, or the big leadership names like a Microsoft or something? What would any of you see that would tell you that this tech story is just kind of gone? Or is that not even something we ever have to worry about? What, any of you have a thought on that?
Are you saying that it's disappeared by way of gone?
Well, yeah. So I mean, so the relative strength has held up very nicely, and it strikes me that you're all suggesting with at least one stock pick that technology is still going to be a good place to be. What would you need to see either in the chart of tech as a sector or on some of those individual names that would start to tell you technology is no longer the theme, we need to go somewhere else, right? What would be sort of the exit strategy, this sort of long tech theme that we've all sort of hit
I
on?
would be surprised. I mean, quite frankly, we are in a new paradigm universe, and it is entirely technology driven on every level, whether it's healthcare, finding a new cure, whether it's keeping people connected, keeping the economy going, people can still work. So I think there's enough vibrancy there to keep technology in the forefront as far as outperformance. But as far as signs, I would look at the leading underlying groups within technology. We can take a look at semiconductor stocks, SOXX. That's the backbone of all of this that's allowing technology to drive forward. And realistically, trying to see, well, I should pull it up on mine because it is holding in quite well. But if we see a drop in that area, that's been one of the outperforming underlying groups, as has some of these software stocks. We've talked about Shopify, and two of my stocks were software related. So I would look to those leadership groups, and if they start to do a big fade and deteriorate, that could be a signal for the entire sector.
Tom, Grayson, any other takes on the tech leadership theme?
Yeah, I mean, I'm always going to look at again at relative strength, and if that starts to break down, then I'm going to reevaluate. But I think the story that gets kind of lost with the whole tech outperformance feature, in a lot of ways, for sort of the economy moving forward, for this disconnected economy that I'm talking about, technology in a lot of ways is more of a utility than a growth play. I mean, companies that transition their infrastructure up into the cloud, that can't go away. Just because business might slow down, you might sort of pull back on some of your server loads and things like that. But it's effectively the digital version of construction, or the digital version of electricity and water. In a lot of ways, technology is more of a utility for the modern world than a growth play. I see this strength really, really continuing. I mean, it diverges in some sense, based on what the company actually does. But something like Microsoft that becomes a core feature of all these businesses because they are the technology providing, their cloud infrastructure, that really can't go away. And with so many other businesses, hotels and any company really, construction companies, all of these energy companies, everyone transitioning to manage more of their businesses, online and virtually and digitally. That theme of cloud as sort of a utility, I think, only grows from here.
And if I may, I'm just going to share my screen very quickly to underscore what was just commented upon. And we can take a look over the last month. This is the S&P, the 11 sectors and their performance. And take a look here up at the forefront. We have healthcare, consumer staple, utilities, three very clear-cut defensive types of stocks, but technology. So that concept that it is somewhat more of a defensive type of play in the sense that regardless of any economic potential recession, there's still going to be a need for those products.
Yeah. And what I love is you guys are all talking. I love that you have thought through why these things should work, but there's a technical orientation. And I think, Grayson, you mentioned it. Here's what I think is going to happen. The relative strength is going to tell me whether or not this is actually happening.
Right.
I think that is a beautiful way to put it. If I could transition to a minute, maybe Tom, you could start with this. One notable absence, I would say, in terms of what was underserved in some of your picks. I would say it's sort of two main buckets. The one would be some of the really defensive sort of yield-oriented plays like real estate or utilities. And again, I know it's not the sexiest stock picking opportunity ever, but it strikes me that there were no real yield opportunities necessarily in any of your picks. And then the other one would be something really beaten down like energy, right? Like a Chevron or something that's been completely beaten down. Is there anything in any of those sectors that you would need to see, or that would maybe suggest to you that that's a ripe opportunity for long positions? How would you think about those groups?
Well, I could tell you that in terms of energy, I don't know if you have a chart, if you want to throw up, Dave, or I can throw one up, but similar to what you were showing with the XLK, if you pull up the XLE, for instance.
Sure.
And then maybe even add the accumulation distribution on that down at the bottom. Yeah, under your.
We are testing Mary Ellen's StockCharts capability, and she's passing.
Putting hers in test.
With great success.
Beautiful.
Yeah.
Well
so if you take a look at this, now you can see the accumulation distribution going down along with price.
Yeah.
Now, if you go and, as far as I was, when I was looking at, say, the XLK with that same, you go down a little bit further. Yeah. If you, we're going to get there. Up, whoop.
Sorry. Oh, my word. Okay.
Yeah, we just get rid of the Arun there.
There we go.
All right. So if you're looking at the XLE, you can kind of see that accumulation distribution has been going down with price. Now, Mary Ellen, if you go up to the XLE and just change that back to the XLK, this is another way to look at, what's been going on here over the last 30 days. Look at the XLK, which is way below in price where it was, but yet its accumulation distribution's been going higher. Now, again, I don't know that I haven't looked at all the sectors. I'm sure a number of them probably are going up simply because that's the way the market's been operating, gapping down and then actually doing better throughout the day. And that's going to result, for the most part, in an accumulation distribution that's rising. But when you look at XLE, to me, there's no way in the world I would be getting involved in energy right now. I mean, and somebody could be saying, well, my gosh, the value there with crude oil at $20 a barrel. Well, that value was being screamed when it was $50 a barrel. and now it's 20, and these stocks have been absolutely obliterated. That's right. As a technician and as somebody who follows trends and as a momentum investor, I don't try to call bottoms. And so in something like energy or some of the other areas that you talked about, on a relative basis, these areas are not performing well. And until that changes, I'm not going to argue with Wall Street. I'm going to go with what's working.
Yeah. I think this wise analyst named Tom Bowley, and I'm paraphrasing, said something like, if you want to outperform the S&P 500, you need to own stocks that are outperforming the S&P 500.
It's brilliant, isn't it?
Beautifully.
Yes.
And utilities has a unique occurrence that a lot of people aren't thinking about, but it occurred first in Asia, then Europe, is the fact that with this corporate shutdown, it's just been a huge downdraft in demand for energy. So this increased demand from people staying at home is just in no way going to overcompensate for that. So last week we saw a lot of issuance, a lot of these bigger utility companies raising money by issuing bonds to shore up their capital. So.
Yeah. So just a couple of other final questions, and then we're sadly going to be out of time. So and again, I don't mean to nitpick on what you didn't mention, because I don't disagree with how you all approach. I think you came up with some great themes and some beautiful charts. Another thing that strikes me is gold, or any gold-related names were sort of noticeably absent from all of you. And I'm curious, and again, not necessarily that it deserves to be one of your top 5 picks, but any of you, how would you think about, and it doesn't have to be the GLD, which I'm showing here. It could be like Newmont, or, one of those, Royal Gold, or one of those gold-related mining stocks. Is there an opportunity with something that's more, diversified, in terms of a diversification exercise, getting into something like gold or gold miners, or is that something you would avoid for some sort of technical or macro reason? Any thoughts there?
I would just say this, because when I went through my exercise of looking at where the S&P was back on February 19th, where it was on March 23rd, and then looking at the various groups, the number 1 and number 2 industry groups over that period were gold mining and mining.
Sure.
So as you mentioned, the difference is, I think, in my, what I was trying to do for the show was to come up with themes that where we're actually changing, that something is changing as we go forward. Nothing really changed here. Gold mining and mining shares do well when the market's fearful. And so, you go back and you look at history, these areas outperform when the market is fearful. I think once we start to turn back to the upside, I don't think there's any change. I don't see a theme where gold mining and mining are going to outperform the S&P 500 when we start rising again. So my take would simply be, and I looked at it, and of course, it did come right up on my schedule, number one, number two, industry groups, but I don't see a theme emerging in those two areas. So that would be my response.
Great point. So folks, we are almost out of time. I want to finish with 2 rapid fire questions, if you'd indulge me. So I'll ask the quick question. We'll go 1, 2, 3, starting with Tom. You are subjected to my very busy S&P chart, so apologies for that. But I know you're familiar with what the S&P chart looks like now. So my question, and this is a question we're going to be asking our viewers on StockCharts TV very soon. Right now, the S&P ending the first quarter around 2585. And my question to you, and again, I know this is speculating a couple months down the road, but by the end of the second quarter, which of these 3 outcomes do you foresee? Do you see us breaking above 2,800 on the S&P, or option B, breaking below 2,300, or option C, at the end of the second quarter, we're still within that range of 2,300 to 2,800? And briefly, very briefly, generally, why are you thinking that? Tom, what do you think?
Can you give me what happens with the coronavirus, please?
That is something I cannot do. So I know that's, and again, that's where we're at, right?
Yeah. I mean, I can't see, I think that we're going to be in an incredibly sharp recession. And obviously that's what the market is pricing in. And unless we have some miracle cure that just all of a sudden appears, which I'm not expecting, and I don't think most health experts are, I think you got to base it on what we're seeing right now. I think the market's very fearful. I think there's a lot of uncertainty in the market going forward. I would be shocked if we were above 2,800 in another couple of months. That's just my opinion. I think the key is going to be whether or not we hold the lows. If we roll back over, do we hold that March 23rd low? If we do, because that's how 1987 went. We went down, got that double bottom, and then off to the, back to the upside. I would just say that when I look at this, the S&P 500 and all the major indices are in a secular bull market as far as I'm concerned, just like it was back in 1987. And this drop is very similar to 1987. So I think on the tail end of this, we are going to accelerate back to the upside. But whether we do it in the next 2 months, I think is very difficult to say. I think we just consolidate here over the next couple months.
Great answer. Mary Ellen, do we end the second quarter above 2,800, below 2,300, or in the middle? What would you say?
Well, I would have to say that we definitely are going to have a very difficult period ahead of us. Earnings season is going to start next week. We've already seen in China, they came out with their estimates for their economic results for the first quarter, and the markets, they dropped 5% on negative news. So that's going to be a very severe headwind going into these next 2 months. So I always keep an eye on my shorter term simple moving averages and looking currently for support at 2465, but that can change on a daily basis.
Got it. Grayson Roze, what say you? Below 2,300, above 2,800, or in the middle in a couple months out?
I think we do need to go lower. I think that there's a chance that we even test some levels around 2,100 on the S&P 500. I think that what we're seeing right now is, I'm kind of calling it the mother of all overhead supplies. This decline has been so rapid. It's been deep, it's been painful, and I think it's caught a lot of people off guard. So I think that's going to be a continued challenge for any sort of relief rally that we see. I think we're getting up to some price levels where people just start to say, there's so much uncertainty, I need to sell. I was too fearful when it was, 34% off the highs, but now that we've come off that a bit, I'm getting out of some positions, resetting, all of that stuff. So I think there's still so much uncertainty here. We need a bit of a healthier shakeout and a more, sort of sustained shakeout. This has been really, really quick. 1 month down and back up a bit is just very, very quick. So I don't see this being a V bottom. I see us definitely retesting those levels around 2350 that we were at before. And I think that if we break down below those, there's a good chance that we go back near, around 2100. Those were kind of the highs that we saw in 2015 and 2016.
Sure.
So I think that there's a chance that we retest those levels, which frankly for me, on the longer term side of things, is a bit of a healthier shakeout, a more complete shakeout here. And at that point, I think we're at a better price level to really see a sustained rally coming off of there. Hopefully we see, I don't know what Dr. Dave says about his, coronavirus outlook here, but hopefully we see some good news coming out there. And from those lower levels, we can put in more of a complete rally.
Well, guys, this has been a blast. I wish we could go on for much, much longer than this, but we can't. So I'd love to wrap up this way if we could. You each get 10 seconds to speak to a younger you that has not been through one of these bear market cycles. What would you tell yourself back then just to help you get through this period? 10 seconds each. Tom, what would you say?
Stay the course. I mean, I'm a believer in the U.S. I'm a believer in our economy going forward. I think that, we have these periods that we get tested and we bounce back. So I would stay the course from a long-term perspective.
Mary Ellen?
And along those lines, the fact that this too will pass. We've seen catastrophic events historically, and the markets do have a way of stabilizing and eventually righting themselves.
And Grayson?
100-year chart. Go look at a 100-year chart of the Dow and tell me that we're not going to get through this. It's just not true. So I think I'd be telling my younger, less experienced self, 100-year chart.
Well, the consistent answer for all three of you, with 100% accuracy, all bear markets have been followed by bull markets so far. So hopefully that is the case here as well. Cannot thank you all enough. How fortunate are we at StockCharts to have people like you willing to help and share some guidance. So Tom Bowley, Mary Ellen McGonagle, Grayson Roze, thank you so much for all you're doing, and thanks for joining us today on the show.
Thanks, Dave.
Absolutely.
Thank you,
Dave.
Yeah, everyone, thanks for watching. This is Dave Keller from StockCharts.com in Redmond, Washington. Be safe. We'll see you soon. Thank you.
Hey guys, Grayson Roze here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.